Tom and I are both partners with SeatonHill. A little bit about SeatonHill. It's a leading fractional CFO firm here in the country. We just do CFOs only. It was founded, I'm going to guess, about 15 plus years ago by some former Tatum partners. There are 90, 94, 95 of us that are part of the group today, coast to coast, from New York to LA, and probably 20 odd in Texas, as that's where the firm was originally founded. So that's our that work all right there?
Yes.
So we have again 90 plus CFO partners. We've been in 178 different industries, and we've got, as it says, 23 average years of experience. I'm on the heavier end of that scale, so I'm a little bit beyond. Here are some of the firms that our company has, our CFOs have got background with. So we come from some of the largest and most diverse firms in the country. And if you're interested and you look at our website, everybody is categorized there by, what industries they have history in. So if you want somebody specifically in a particular area of interest, then they're categorized there. So I want to turn the ball over to Tom at this point. His experience is with large portfolios, as with Trammell Crow, and what they have done with their large portfolios over time, and how they manage those from the CFO's perspective. My perspective is with high net worth individuals and family offices who had real estate as one of a diverse set of alternative investments that were in hedges to the swings of market conditions. So we bring a little bit different perspective, and we'll both comment throughout. But I'm going to turn the reins over to Tom at this point.
Webb,
and
go ahead, Webb.
No, I was just going to ask, and feel free to interject with questions at any point. If there's something you'd like some clarity on, we'll be happy to try and address your question.
Yes, exactly. Thanks, Webb, and I agree. If there's something here, just interrupt. We've got a small enough group that definitely want this to be interactive and not just a presentation. So feel free. I don't know, Olivia, is there a feature where I'm not familiar with the Google product here, but is there a feature where somebody can put something in a chat, or do we just have to ask questions?
Oh no, yes. There is a chat on your bottom right of your screen. You should see a little chat box that you can click to type in comments, questions, or introduce yourself and your market, as some of you already have. So again, you will find a little chat box on the bottom right of your screen, right next to the number of guests on the line.
I got it. Okay. I just want to make sure. Feel free to just speak up. You don't have to put it in the chat. But anyway, thanks for that introduction, Webb. I guess I want to start. I guess one thing, Webb, you're going to be driving the presentation here, so you'll have to flip the screen since you've got it pulled up. This first screen we have just talking about market conditions, and based on the audience that we have here, I think it's good just to have a general overview of where the market is, because the market conditions affect every industry, and it seems like we've got a variety of participants here, some in real estate, some not, but everybody's affected by real estate and by current market conditions. A key point here, capital's still pretty expensive. And anybody who's been in commercial real estate just realize that it is a very capital intensive business, unlike some other operating companies that don't have that feature. And we'll talk more about it, but whatever happens on interest rates is important because capital it's again, real estate's very capital intensive. So we've been in a period of relatively high interest rates, and I would say that's relative because although it seems very dramatic that the Fed kept raising rates between 22 and 23, and now they've eased off a little bit, you have to put that in historical perspective. The rates aren't that high by historical perspectives. Looking back 20, 30 years, we've seen rates much higher, but the dramatic increase is really what put a shock on the commercial real estate business here the last couple of years. The Fed had rates super low, almost at zero, the Fed funds rate after COVID, trying to stimulate the economy. And then, of course, the economy got stimulated and we had pretty high inflation. So the Fed took interest rates from almost zero up to about 5.5%, Fed funds rate of about 5.5%. That rate's now just a little bit over 4%. There was a rate cut in September. Everybody in real estate and a lot of other industries are holding their breath, wanting more rate cuts to try to get interest rates lower. There's another one that may happen this week, probably another quarter point, maybe another one by the end of the year. So we think we're in a Fed easing cycle here. These higher interest rates have definitely had an impact on transaction volumes the last couple of years. There was a lot of transaction, and I'm not sure what you see, Libby, but there was a lot of transactions in 21, 22, 23. It really slowed down as buyers had more trouble with making the numbers work with the interest rates higher, and banks tightened up their lending standards and just took a more cautious approach. One other point here is that there's a large amount of commercial real estate that's going to be refinanced over the next few years. A lot of that, if you think about it in terms of timing, may have been some really low interest rates put on properties right after COVID that may be 5-year loans that were done in 21 or 22. They're coming to renewal in 26, 27. Be interested to see, very interesting to see what happens with those renewals because it may be at a higher rate, or maybe the lender just extends the loan to keep to help out the landlord. On the economy side, broad economy, who knows? It's stable every day. It changes. I don't know what everybody's looking at for their 2026 budgets, but it seems like everything that we hear, everybody's cautious, optimistic, but cautious because there's signs of slowing job growth. Inflation has been under control, but have we, really seen the full impact of the tariffs? The economic data is difficult to understand sometimes. The government data gets revised, a quarter or two later, and maybe we didn't have as much job growth, it looks like, over the last 12 months as we thought we did. And so it's just difficult to understand where the economy's going. And the tariffs, I think a lot of the suppliers have eaten the cost of the tariffs and haven't pushed that onto the ultimate consumer. It has impacted commercial real estate development some, but it's more the uncertainty of not knowing from day to day what the tariffs are going to be, what our partnership with our trading partners around the world is going to be. So I think that just creates a cautious wait and see type environment. And lenders are fairly cautious right now too. So that's just kind of a broad overview of the economy. We're going to talk a little bit about, on the next slide, specific market performance and trends. Commercial real estate has, and these are just four areas of commercial real estate. There's more than this, but industrial, office, multifamily, and retail are a few of the big ones. And industrial has performed very well, especially coming out of COVID with e-commerce growth, with a lot of businesses caught in the supply chain problems out of COVID, and the realization that we rely on, goods from all over the world, and if that, something shocks the system like COVID did, it really messed up our supply chain. So that has created more focus on nearshoring, onshoring, not being so reliant on the worldwide supply chain. Definitely has helped out industrial. Just a couple of stats here on industrial. The vacancy rate currently, from some recent stats, is about 7.5%. So 93, 94% occupied. That's pretty good. There's a lot of demand, and you probably hear it in the news about data centers and all the news around artificial intelligence. That's only going to keep growing. One of the big challenges there with data centers is power. Are we going to have enough, electric? Is it going to stress the electric grid and so forth? So I think there's more demand for data centers than can be built and supplied with power at this time. On multifamily, would be the other sector on this page that has been strong. The fundamentals remain strong. The high home prices contribute to more people renting, less people buying. Although multifamily, because of the job growth after COVID, the multifamily developers got really busy and started building a lot in the last 3 or 4 years. So there's a huge supply of new multifamily in some of these markets. And again, all of these sectors are very market specific. I'm giving broad national discussion here, but depending on what local market you're in sub-market, it's all very local and very specific. For example, on multifamily, I mentioned industrials, 7.5% vacancy rate. Multifamilies, about a 5% vacancy, 6% vacancy rate nationally. But if you look at certain markets like Houston, Houston's not too bad, but Austin had a tremendous amount of supply delivered and coming on the market. It's also got really strong job growth, but Austin's vacancy rate is 13, 14% right now. That, at least the predictions are that will all get absorbed pretty quickly, because there's not been as much new construction and there's been great job growth. Phoenix is similar. Phoenix has got 9-10% vacancy rate, higher than the national average, but Phoenix is also a good, strong job growth market. So probably not a long-term problem. If you're a multifamily developer owner, you want to be in Houston, Austin, Phoenix, but you might be a little bit of pain here in the next couple of years as we work through the supply and are not able to increase rents like we have been over the last few years. Office, again, another one that's affected by a combination of COVID and technology is office, because as we know, everybody went home and worked from home for a while and figured out that you can get a lot of things done with technology. Just like the meeting we're having here today, we don't all have to fly around the country. We don't all have to be in an office. A lot of people working from home offices. So office has the highest vacancy rate of all these groups right now, about 20% vacant nationally. But in some markets and sub-markets, it's a lot more than that. 30% vacancy rate in downtown Dallas is pretty common. But you go move a mile or two north to Uptown, which is adjacent to downtown Dallas, and it's much higher occupancy and higher in the suburbs. So there's a lot of people that, I think a lot of downtowns have really gotten hurt by COVID and all the businesses that support those office workers. So office is in a transitional space right now. One of the other trends in office is converting office buildings to residential, to condos and apartments, and a lot of that has been done in different markets, but it's expensive and it's hard to retrofit those buildings. So that's not a huge part of what's going on in office. Saw something the other day about New York City. New York City, just over the last several months, has had the highest volume of leasing activity in almost 20 years. So I think a lot of the mandates from, JP Morgan and some of the other, office, financial services companies in New York say you got to be in the office 5 days a week. That has really, driven it, and people want to be in New York, financial center and everything. So New York seems to be an outlier here. Retail, that's mixed and very dependent on specific submarket and different properties within each geographic submarket. I would say one thing is not on the page here, but I spent about 10 years as CFO of a senior housing company. So senior housing is something to watch just because of the size of the baby boom generation. And we've got if the baby boom is generally that baby boomer generation generally thought to be people born in 1946 to 1964, give or take a couple of years. All of those people are now 60 to 80 years old. And so senior housing over the next couple of decades is going to be a good place to be, whether it's in independent, active adult communities, assisted living, skilled nursing, memory care. There's different segments along the continuum that are going to be strong for years to come. All right, we can go on to another slide there. Okay, now getting into most of our topic here, the portfolio management challenges. Efficient capital sourcing and allocation is a big challenge in any commercial real estate organization. And the CFO is generally involved in that, may not be the one actually out there raising the funds, but hopefully has a seat at the table in making decisions about maybe in conjunction with an investment committee about where to invest in new development, acquisition, timing of sales, all of those kind of things. The typical, just for those who aren't in real estate, the typical what real estate calls the capital stack, which is the capitalization of the facilities. Real estate is, I mentioned, it's a highly intense, capital intensive business. Generally you have some type of leverage, some type of debt, because if you just think about an organization only has a certain amount of equity to go around, a certain amount of third-party equity partners they can go to. So generally real estate is financed 50 to 80% leverage. And I'm talking about commercial real estate. And that is, then the bulk of that difference is made up by equity. So a typical deal might be 70% debt, 30% equity, and within that equity component, a large share of it, most commercial real estate companies go out to third-party equity providers such as family offices, private equity, pension funds, sometimes life insurance companies, or the whole range of funds and organizations that invest in real estate. And then the real estate company itself, their ownership team is generally putting in some type of a co-investment to make up that capital stack. The other point on portfolio management challenges, and we'll get into this in a little bit more, but one of the big challenges that I think everybody who's been in commercial real estate, I've certainly experienced it, is just data visibility, I would call it, or how do you look at information on a consolidated basis? Because unlike an operating company, let's say you've got just a big corporate entity, Apple, Google, somebody like that, they roll everything together. Very sophisticated systems. They roll everything together and are easy to, just produce information for Wall Street every quarter. I'm sure it's not easy, but they have one entity they roll everything up under. Real estate is very fragmented in that generally there's a specific ownership entity for every property. And in my experience, you've got for risk management and not wanting to cross collateralize your liabilities across all the properties, you have different partnerships, limited liability companies, corporate entities that each individual real estate property has a separate ownership structure. And if you go out and get joint venture partner money from a fund or a private equity investor, they don't want their money commingled across all these other properties you might have that have no common ownership. So for that reason, it's going to be fragmented. And so the challenge is, how do you have the visibility across the whole portfolio? And if you ever want to consolidate information, it's a challenge. So with that, we can flip on to the next one.
Tom, can I take 1 second right there, talking about data and the families and offices that I've been in? There were a lot of discussions over the years about Yardi versus RealPage versus others. So could everybody drop in the chat what systems they found best for just basic tenant management, and we'll take a look at that. Thank you, sir.
And Webb, can I just also, Frank Edelman here, can I just interject real quick? I just want to clarify, you're speaking from the perspective of a holding company that's holding a variety of real estate assets and then leasing them out to tenants or other occupiers. My own personal perspective is coming from a slightly different perspective. I'm coming from a corporate occupier perspective as an occupier of, dozens or hundreds of entities. We're dealing with dozens or hundreds of landlords, like who are, I think is more the role that you would be playing in that scenario. And so we have that exact consolidation and data consistency issue. And I mean, speaking from a tenant point of view, an occupier point of view, our challenge is to integrate financial measures, which we have in spades, with non-financial occupancy measures, so maintenance, utilization, seat assignments, our portfolio management. So what spaces are we occupying in multiple properties around the country, around the world? So I think we have the mirror image of the power of the issues that you're describing right there. Speaking as an occupier.
Thank you, Frank. No, you're exactly right. We were the property holder managing many different tenants.
So that's great perspective. And that would be interesting to see what all, as Webb mentioned, what systems everybody has run or is running. We at Trammell Crow used Yardi, and we're happy with that. And but it's great on the property management side. You still have this challenge of trying to consolidate information, fragmented ownership information, different entity information. So and this is my must-have reports. This isn't necessarily what anybody else, should use. But if you've got a portfolio of real estate, and so if you just think about when I was at Trammell Crow Residential, we operated in 20 different markets, probably sometimes 15 to 20 different markets around the country. And we were headquartered in Dallas. So I'm sitting there in Dallas trying to manage this portfolio from all over the country, and it was mostly apartment buildings. So we were a developer, contractor, owner, operator throughout the history. And sometimes we used third-party management companies, and we eventually sold our internal management company to a group of internal partners. But we were involved in everything along the way. So I needed tools where I could know exactly what the status was of each one of our projects. Is it in pre-development, where we are pursuing all the entitlements and the pre-development work that goes into getting the property approved? Is it under construction? Is it in lease up? Is it fully completed? Are we trying to sell it? What's the status of the portfolio? And so I always had what I called, it was really our asset management report, but I just call it here a portfolio level summary. Just something where I can have, pull up a schedule, and I would usually print the thing out and have it in a binder. So it was sitting on my desk and I could just reference it anytime. A portfolio summary report with key financial metrics, of course, the property name, location, number of units, that kind of thing. But then I would include reporting deadlines, lease expirations, debt maturities, I would include debt service coverage ratios, so I knew that what lenders we were potentially going to have conversations with if we were short of meeting debt service coverage tests, or it looked like we could come up short. So that is one report. Then beyond that, if we had 100 properties around the country, I might have one portfolio level summary report with key data on it, and then 100 separate asset level reports. Each one of these, maybe this portfolio level summary report's updated quarterly. The asset level report would be a real working tool, which we could sit down once a month, look at performance, talk to the property management people, talk to the asset managers, the other regional CFOs around the country, that kind of thing. So it would be something where we would get on a conference call or in a meeting and dive into the details of property performance. And some of the key metrics we looked at would be net operating income, which in real estate, that's the key number. It's just basically your revenues less your operating expenses gives you net operating income. It's basically the equivalent of an EBITDA in an operating company. It's just terminology is a little bit different and the math is slightly different. But to understand the value of your property, all of real estate is, at least commercial real estate, is valued based on cap rates. And the cap rate is just an inverse of a multiple. So if you're listening to CNBC and you're talking about some corporate entity with a multiple of, a technology company with a multiple of 20, the inverse of that is a 5% yield. So that's a 5% cap rate. We just, in real estate, we just take the net operating income divided by the cap rate to come up with value rather than taking a multiple of the net operating income. But we would measure, lots of other metrics, but I just put some of them on here. Cash flow, of course, is important. We want to understand our yield on the cost of construction. So, if we built a property for $50 million and it's yielding, we wanted to know, is it yielding 5%, 7%? How does that compare with the cap rates in the market to give us a sense of the valuation? Of course, occupancy trends, leasing trends, all different categories of expense trends, but there would be information on all of these and other metrics that we would keep on these kind of one-page asset level reports that we would talk to property management about every month.
What was the typical debt to equity ratio you were targeting at Trammell Crow? Was it different by segment?
It varied over time, but it was generally, it depends on what the banks would finance. But in general, and what we were comfortable with, we didn't want to go as high as 80% debt. We would generally be 70% or so. And in some properties, we would be, between 50 and 70%.
Okay. All right.
Okay. So that's just a high level overview of how at least I manage the portfolio. There's a lot of more details and nuance in there than we can get into on this presentation. But I thought it would be helpful also to go into lessons learned, because over the years, definitely learned a lot of lessons. And one of the key things here is I just framed it risk preparedness and relationship management. You can't be too prepared, and you can't have too many good relationships. When in the good times, it's easy. Occupancy's high. You're raising rents. You're making money, and you take some of these things for granted. But when the economy turns, it's best to be prepared. And so, one of the lessons learned is conducting scenario planning and stress testing the portfolio. So that portfolio that I just mentioned, where we might have a portfolio report that has all of our yields and data on performance, we would take that and stress test it and just say, okay, what if we dip into a recession in the next 12 months? And what does that look like on what happens to our yields? Then, as a result, what happens to our debt service coverage test? And just stress testing it to make sure that we knew how much coverage we had in case things went sideways in the economy. What if a major tenant, if you're in office, what if a major tenant doesn't renew and they take up 20% of the building? What does that do to your numbers? What if occupancy declines 5%? What if you're monitoring the new supply coming into the market and you've got a property in, suburban Dallas, Texas, but your competitors are putting in, 2 properties down the road. What's that going to do to our occupancy? Testing those things on a periodic basis. Back to the maintaining equity cushions. You can't, when the downturn, you just can't have too much equity. It's great to be, to have high leverage of 70%, as I mentioned, in response to Webb's question. It's great when you can spread your equity over a huge portfolio because you've got a lot of leverage, but leverage works both ways. And when there's a downturn, leverage is not your friend. That property that you might have stretched a bit to finance at 80% leverage, if your value goes down 25%, all your equity is wiped out. If your value goes down that much and you're only 60% leveraged, you can hang on to that property and live to play another day, and hopefully work out the transaction with your lender. Speaking of lenders, you just can't have enough lenders and enough good relationships because when times are tough, you want those relationships to stick with you and work with you. You don't want them foreclosing on your building just because you're unable to make a debt service payment 1 month or whatever. So you're having a diversity of relationships and multiple relationships you can count on are good. The other lesson learned is these downturns happen quickly and you just never see them coming. You could go back in history more than 25 years. We're just going back 25 years. There's always been something happen that nobody really sees coming. I guess the .com bubble, for anybody who was around during that period of time, was probably somewhat predictable, but there was a huge rush of money coming out of Silicon Valley to fund anything that had .com associated with it. A lot of businesses started up in some of the tech heavy markets, Denver, San Francisco, Austin, and we built lots of apartments in those areas. And then the .com bubble kind of burst in 2000, and it was kind of painful. Followed up the next year by the September 11th attacks, which of course.
Tom, if I can just interrupt you just a second there. I was with a family. We had purchased a trading business in downtown San Francisco in the mid 1990s, and the .com real estate boom pushed us out of San Francisco. We could no longer afford the rents, and then so we moved the business to downtown Oakland. And we were on the town square, and the .com boom eventually caught up with us there. So the company now resides in the Woodlands. So we ultimately had to move it out of California entirely. So that was the other side of that .com boom. So
yeah, for sure. That's well, again, September 11th happened. Who could have seen that coming? Nobody. And of course, there was a huge human aspect to that, but on the business side, everything stalled out. That you didn't have to be in real estate; it affected everything. But again, it goes back to that scenario planning. You can't plan for a September 11th crash, but you can do some scenario planning and say, what if occupancy drops 10%? What if we go into a deep recession? What do we do? How much equity do you have? How much cash in the bank do we have as an organization to weather a storm? Which properties could we quickly sell to raise funds to bail out another property? All of those kind of scenario plannings. If something happens, you've got that and you can pull it off the shelf. You've talked about it with senior management. Everybody understands what plan B is if plan A goes sideways. So I think in just from a CFO standpoint, I kind of think of the CFO as the almost like risk manager for the organization. You've got, people out there whose jobs are to lease and to develop and to charge hard on new activity and grow, which is all great, but somebody has to be overseeing the what if and the kind of risk management and be the kind of the truth teller within the organization to make sure people don't get misled by things are always going to be got an arrow that's just going to keep going straight up, because it's never that way. It's always lumpy. Won't spend a lot of time on the great financial crisis, but anybody that was around during that period of time, some people call it the Great Recession. It was really more of a global financial crisis. Nobody could have predicted that the whole banking system would just collapse and have to be bailed out by nationally by the federal government. We had, just as an example, Trammell Crow Residential was the largest apartment developer in the country for a number of years leading up to the great financial crisis. And we would usually start construction on 15, 20 properties around the country every year, fairly consistently. We did not start a single project in 2009, 10, or 11. So 3 years with no projects started. There was no financing available. Throughout the commercial real estate industry, heavy layoffs in development, construction personnel, architects, engineers, people like that focused on multifamily and other real estate development were just out of business for a couple of years. So hopefully we won't go through another one of those, but that was a significant event. Of course, COVID, who could have predicted that? Just another thing. And so I guess my only point here is not to be a real, negative, have a real negative view here, but there'll be another recession. It's not a matter of, if it's going to happen, it's just when it's going to happen, whether it's next year in 2030 or 2035, who knows? There'll be another recession. So just plan for there to be a downturn at some point.
Tom, can I interrupt real quick?
Yeah.
Yeah, sir. I keep hearing about some kind of magical rate for things to unlock more on the commercial real estate. I hear like 5.5%. You have an opinion about what the exact rate is for things to kind of free up a little bit in the commercial space, in your opinion?
Not really. I mean, everything is kind of pegged off the rates are pegged off some margin of a 10-year treasury yield. So I would watch that. The Fed funds rate, as I mentioned earlier, has gone from 5.5 down to around 4. If they keep lowering it down to in the 3s, if it gets down to 3%, and then you add some sort of a spread on top of that, you might be getting into the numbers you're talking about. I don't know that there's any magical number, but I would say if we drop another, 75 to 100 basis points, that would be where interest rates are really in a more favorable spot.
Okay, understood. Appreciate it.
Tom, I bought my first house in the 1980s with a 16.5% 30-year mortgage.
Yeah, we bought our first house in the early 90s with a 9.5% mortgage. Yeah. So rates have been higher.
Yeah. Yes. Yeah. So.
I'm at 3.8, so I keep my mouth shut.
Yeah. The point here on loan maturities, proactively addressing those. Sometimes it takes 6 to 9 months to work with a lender to get a loan refinanced. The last thing you want to do is come up against that maturity and have waited too long. I'll give you one example, and it was not even in our real estate business in Trammell Crow. It was with the healthcare company I was with, senior housing company. We had a portfolio with over 100 facilities around the country, 9,000 employees, and we were operating under a line of credit that was really the lifeline of our business. We had been in this long-term relationship with the bank, and I had every expectation, and they kept telling me they were going to renew it. And it was a $50 million line of credit. We use it for some acquisitions, but mostly for a working capital line of credit. And we were $40 million drawn on it. And they, at the last minute, well, last 2 weeks before we were going to renew it, they were going to renew it for another 5 years. They said, we're not renewing it. And I talked to my relationship manager. I was like, you said you're going to do it. Well, Tom, it's out of my hands. This came from the top of the house. They just don't want to, they don't want to do it. And I had to scramble, got them to do a 3-month loan extension while I worked with another lender. They said that was the last extension they were going to give, and we closed on with the new lender 3 days before the loan was ready to mature. So it was a stressful few months. The lesson I learned from that was to have a backup plan, be talking to other lenders. Don't rely on this one lender saying we're gonna renew. It was a painful lesson because it was a stressful time leading up into that debt maturity and refinancing. Focus on core responsibilities here. We've been talking this entire time about portfolio management, kind of financing and that kind of thing from the CFO perspective. But generally a CFO, and certainly depending on what your role is as a financial manager, FP&A, controller, you've got a lot of other responsibilities too. CFO generally has responsibility for risk management and insurance, sometimes IT, often the HR team, which includes benefit renewals and things like that. So you get into, you can't get so focused on, loan maturities or working on the portfolio management and avoid what's happening with the rest of your team, because you've got to have a good team reporting information to you consistently. You've got to be proactive about insurance renewals. I'm sure everybody right now who's involved in benefit renewals are seeing increases. I'd be curious to see what people are seeing. I'm hearing 10 to 15% premium increases across middle market companies. Does anybody have any perspective on that?
And that's the same as what we're seeing out here in Arizona. That's Blue Cross Blue Shield Arizona. That's their standard line right now.
Yeah, we all know that's just unsustainable. Other insurance renewals, property insurance from time to time has been challenging. It was very challenging the last few years with all the fires and floods and disasters and things. So insurance, definitely stay on top of those things. Don't be surprised, and because that changes your pro formas, it changes your value of your properties with, especially if commercial insurance goes up significantly. But even the benefit plans and health insurance has an impact.
All right. Any other questions or comments for Tom?
If I may, quick question. Obviously, this morning on the news, there was a big announcement from Amazon, right, preparing to lay off 14,000 plus corporate type jobs to kind of streamline their company, cut costs. Now the impact, talking about industrial product and the product type within commercial real estate, Tom, I'd be curious, when you saw the news and you hear about this, we understand what was announced and how it was announced this morning to the wider public, but thinking industrial, what is your thought on that?
Yeah, I mean, I think it's just more of a broader question of artificial intelligence, because part of what I read was similar to what you're seeing, that it's efficiency. They've got some AI capabilities that are going to replace jobs that are more routine, whatever those jobs are. They also, in their press release, I think, said something about they're kind of right sizing a bit for some over hiring that happened post pandemic. So it may not all be related to AI, but I think that to me is the thing I look at, is what's the broader. None of us really know what the impact of all of the AI is going to be. whether it's, and the impact on jobs, for sure. So that would be my main thought as I hear that.
So if you're Blackstone, for example, sitting on a portfolio of industrial product, would you want to then kind of do a stress test, scenario analysis, thinking about what that could mean?
Yeah, I would think so. I would definitely be thinking in that direction. I guess, one other thing that we didn't talk about, Evan, just throw it out there for 1 30-second thing. We didn't talk at all about single family housing, and that's a huge part of real estate, not necessarily commercial real estate, but it impacts it. There is a shortage of housing in the whole, nationally. There's about a shortage of 3 million homes, and that's a result of the great financial crisis of 2008, 2010, where nothing was built. And coming out of that, then, market by market, it's different as to why home builders aren't able to build enough. But we've got a real housing crisis, especially at the affordable housing level, nationally, that, will be something to keep an eye on. Do the policymakers in Washington come up with some solution? They can't seem to come up with solutions on anything, so probably not. But at some point, are there going to be incentives for developers to build, or for home buyers to buy? Because a lot of people are just completely shut out of the home buying market because of the costs and lack of available supply.